You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Thanks for having me.
I heard on MSNBC a big debate about Apple and its huge pile of cash. Now, how big is this pile of cash they're sitting on right now? Well, apparently they could buy General Motors, Ford, and Tesla and still have a spare $41 billion to play with. Is that the kind of problem every company wishes they have, Mike?
I'm sure it is, but it actually is a bit of a problem. As crazy as that might sound, because what can they do with the money? They can. Are they going to be able to invest in new operations and new products with $25-some billion? They probably don't need to spend $25 billion to come up with more gadgets and gizmos. So then, can they buy other companies to increase earnings? In Cisco, in the 1990s, that's what it did. It was buying up companies all over the place to buy earnings, but Apple really can't do that at this moment because most stocks in the stock market are so overvalued that for them to just go out and do that would mean devaluing their own stock. That's just what's happened in the market. It's gone up for 5 or 6 years, and it's just tough for technology companies to make acquisitions because everything is so sillily overvalued. So that just leaves them with two options. One would be to increase the dividends that they pay people, which I think would be a nice thing, a good thing to do. And the other thing would be stock buybacks, which has been a popular thing in corporate America the past couple of years, is to buy back stock. And one of the reasons why is because the economy is very sluggish. Instead of hiring people, they just buy their shares back. And some of them have even borrowed money and gone in debt to do that. IBM was a poster child for doing that until it blew up last October on bad earnings. And it's a dangerous game because Caterpillar also was one of the big buyback companies of their shares, and they got hit yesterday and their stocks performed poorly the past several months. So I don't know, what the right thing to do is with $25 billion. It is a problem, I think, but it is also a good problem to have.
Well, Microsoft shares have fallen. How come they don't have the same problem as Apple does?
Well, Microsoft's kind of interesting because I was looking at their earnings release this morning. Their stock fell about 10% yesterday and was down over 3% today. And it is one of the most, just like Apple, it's one of the most widely owned stocks by individuals. And it does also pay a 1% or so dividend. And, it's a monopoly type company. Apple kind of has a monopoly on these telephones and people's imagination, and Microsoft has a monopoly on Microsoft software. But one of the things interesting about their earnings was they actually sold more physical computer products in this quarter than they did the last one. However, they sold less software, less Microsoft Office, and they were hurt in earnings from overseas sales because the U.S. dollar went up in value, so they got less money for the goods they were exporting and in the dollars that would come back in the United States from their sales. But it wasn't really a horrible earnings release. I don't know, just the news itself, really, I don't think is enough to justify a 10% drop. But yet the 10% drop, it did happen. And a 3% drop today happened. And I think if I don't believe the news justifies it, then something had to justify it. Something had to happen. So why did the stock fall that much? And again, it's indicative of what has happened in the stock market. The stock is simply so highly priced after 5 years of gains that it's at a high valuation, and thereby is very vulnerable to any negative news. And that's basically the stock market as a whole. So just to give you how it's overvalued, Microsoft has a PEG ratio of 2. Now, what the PEG ratio does is it looks at the price you're paying for earnings growth over the next 5 years. So a lot of people just use the PE ratio, which only looks at 1 year of earnings, and thereby can be very volatile and doesn't say anything about earnings growth forecasts. So the PEG ratio will do that. It's, I think, a better indicator. And it's at 2 for Microsoft, and historically 1 is average valuation. So, and Microsoft has a price to sales of around 4, which is very high too. But that's the story all over the U.S. stock market. And the oil stocks are another example of this. They became they still are, very highly valued because people were chasing them to get their dividend yields. And now, of course, they're crashing and crumbling. And it's a tough situation for people in them. And that's just, the U.S. market as a whole has a cyclically adjusted PE of 27 right now. And the cyclically adjusted PE takes the 10-year average PE adjusted for inflation. So it's really a great long-term valuation indicator. And, it's as high, the market is as highly valued now as it was in 2007. And the only 2 times it was at a higher valuation, 3 times I should say, was 1929, 1987, and 2000. None of those years were good times to be an investor or to make new investments. And I think that's where we are right now.
What about gold, silver, and the bond market? Any relation between those 3?
Yeah, the bond market's the same story as the stock market. It doesn't mean it can't go a little high. The bonds can't go up a little higher, but they don't make much sense from an investment standpoint because you just don't get any money out of it. I mean, the 10-year Treasury bond in the United States has been below 2% here the past couple of weeks. In fact, it went a little lower today even. And who wants to lock up all their money for 10 years to only get a 2% return? It don't make any sense to me. In CDs, you can't get any money either. So there's just, someday that's all going to change and rates will go up, and I don't know when that's going to be, but the point is that it just doesn't make investment sense. Now, gold, I think, is something that makes a lot of sense because if bonds go down, they can move counter to that. People will start to buy gold and silver as a safe haven if the bond market eventually starts to weaken. And I think gold and silver, unlike all these other markets, it's coming out of a bear market that started in 2012, and these other markets are all bull markets for 5 or 6 years. Gold is coming out of one. And if you want to be an investor, you really want to invest in things that are at the start of a new bull market and not years and years and years and years through one at high prices. Bargain shop.
How much longer is the U.S. dollar going to charge?
I don't know. And it's interesting about that is, right now the dollar is getting some wind because the euro has been dropping so much. The Russian ruble dropped last fall, and the dollar has been going up. Now, if you turn on American TV, they'll say it's because the economy is about to boom and so forth, but I don't know if that's true. But the thing really interesting about the dollar is gold tends to trade opposite to the dollar. So while the dollar's been going up, people have been saying, well, gold's got to crash. And that hasn't happened. So far this year, the dollar's gone up and gold has gone up too. And if you look at charts historically, when the two trade opposite to one another, then start to trade together, that tends to coincide with a major turning point in the gold market. And to me, that suggests that gold, since November has been transitioning into a new bull market after its low below 1,200 in November.
We'll have more with Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, on your newsletter, you mentioned the silly Super Bowl indicator. What is it, and why is it called silly?
Well, the indicators, I can't remember which league it is, but when one league wins and the other league loses, the stock market goes up 80% of the time. And that's kind of the stuff, it makes for good talk at the day after the Super Bowl, at the cooler and so forth, but it's kind of silly. I mean, you can't really make an investment decision based upon that. And actually, one thing funny about it is that there are probably lots of things sort of like that you hear, but you can't really use and probably don't really mean anything, but they are out there. And I have no idea who's going to win the Super Bowl. So maybe you have to ask someone else that question.
Well, I was just curious about who the favorite was. And at the start of the week, Seattle was a 1 or 2 point favorite. And now New England is a 1 or 2 point favorite. So even the bookies can't decide who's on top.
Wow. Well, that's a really tight spread. Goodness.
And, I mean, Seattle's the best defensive team out there. The Patriots the best offense. They always say offense sells seats, but defense wins championships. We'll find out on Sunday.
I think that's true in the investment world too. I mean, all the time we want to think about, what should I buy? What's a good stock pick? What's the hot market? And this and that. But in times like we're in now, I think it's actually defense that you need to focus on. And defense can make you money. You just like someone can catch an interception and then run it into the touchdown. You can make a defensive play in the stock market and actually come out ahead too. And when we were talking about gold and silver, I think if someone were to put 10%, even 20% of their money into gold and silver, merely as a defensive insurance, that they can actually come out ahead better than everyone else over the next 5 years.
Mike, thanks a lot for talking to us.
Thank you.
My guest has been Mike Swanson from WallStreetWindow.com. You can contact Mike by email by punching in wallstreetwindow@gmail.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.